Let me ask you something. Have you ever wondered why some of the absolute smartest people you know, we're talking doctors, engineers, people with PhDs, get completely wiped out in the stock market? It's one of trading's biggest paradoxes, right? The intelligence that makes them successful everywhere else seems to actually work against them here. So, what's the deal? Well, the answer has almost nothing to do with IQ and everything to do with human psychology.
Okay, take Sir Isaac Newton, literally a certified genius, the guy who gave us calculus. So back in 1720, he invested in the South Sea Company, made some good money, and got out. Smart move, right? But then he had to sit and watch his friends get ridiculously rich as this stock bubble just kept getting bigger and bigger. The FOMO, that fear of missing out, it just ate him alive. He caved, jumped back in with everything he had near the very top, and lost it all. A whole fortune gone. And that's when he said it. I can calculate the movement of the stars, but not the madness of men. I mean, if the man who discovered gravity couldn't resist the market's emotional pull, what chance do the rest of us really have?
And that's what his story really tells us. The game isn't played on a spreadsheet with fancy calculations. Nope. It's played in the 6 inches of space between your ears. At the end of the day, trading is not an IQ test. It's a test of your discipline.
Now, Newton's story isn't just some dusty old tale. It's a massive warning sign that's basically flashing in today's markets, where millions of people are making the exact same emotional mistakes. And the data we have on this now, well, it's pretty shocking.
The scale of this problem today is just staggering. We have data that shows in complex markets like options and futures, 93% of active retail traders lose money. Let that sink in for a second. That's more than 9 out of every 10 people who try. For most people, the default outcome is failure.
And we're not talking about losing pocket change here. The average loss per person in just a single recent fiscal year was 1.1 lakh rupees. This isn't just a tough hobby. It's basically a wealth-destroying epidemic. So why? Why is this happening?
Well, here's the thing. The problem isn't the market. The market's just a mirror reflecting human behavior back at us. The real problem is our own brain, which it turns out is hardwired to make absolutely terrible financial decisions when we're under pressure.
And pretty much every losing trader gets trapped in this exact same predictable loop. It starts with hope when you put on a trade, but as it starts to move against you, fear creeps in. That fear then builds into blind panic, and you end up selling at the worst possible moment. And what comes next? Regret. And that regret often leads you to do the most dangerous thing of all, revenge trading, where you try to win it all back in a desperate move.
Come on, we've all been there, haven't we? Just watching a position go deeper and deeper into the red, telling ourselves, oh, it'll come back. I just need to get back to even. That's not patience, my friend. That is a classic cognitive trap.
There's a name for this, you know? It's called the sunk cost trap. You get so emotionally attached to the price you paid, it becomes like this giant weight dragging you down. But here's the cold hard truth. The market has no memory. It doesn't know you, and it certainly doesn't care where you got in. Holding on is just throwing good money after bad.
And here's where it gets really weird. In almost every other part of life, more effort means better results. You study harder, you get a better grade. But in trading, it's often the complete opposite. The more you trade, the harder you try to force a profit, the higher your chances of losing actually become. And that's because overtrading is really just anxiety dressed up as productivity. So the big takeaway here is this. The market does not reward you for being busy. It doesn't care about your effort. It only rewards you for having a proven statistical strategy, an edge, and having the discipline to execute it. That's it. Nothing more, nothing less.
Okay, so if our brains are wired against us and trying harder just makes things worse, how does anyone actually succeed at this? Well, the ones who do, the pros, they don't rely on being smarter or having more willpower. They rely on something way more powerful, a system.
And this, right here, is the biggest difference. Amateurs trade when they feel good, when they're motivated or feeling inspired. Professionals, they trade based on a predefined, non-negotiable system, day in, day out. It doesn't matter how they feel.
And that system isn't some super secret complex algorithm. It's usually built with really simple, powerful tools. A checklist before every trade acts like a bouncer at a club. If you don't meet the criteria, you don't get in. A stop loss is your emergency brake. And a journal? A journal is like a mirror. It forces you to look at your decisions honestly, not just your P&L. This is maybe the best analogy I've ever heard for a stop loss. It's so perfect. Look,
You wear a seatbelt not because you expect to crash every single day, but to protect you from that one awful time you do. A stop loss does the exact same thing for your trading account. It's your financial seatbelt. See, professionals know they can't predict the future. They don't even try. Instead, they just think in probabilities. For instance, you could have a strategy that only wins 40% of the time. Sounds bad, right? But if your winning trades are twice as big as your losing ones, you are going to be profitable over time. It's not magic, it's just math.
So if you were to strip everything else away, all the strategies, all the indicators, survival in the market really just boils down to one single unbreakable rule. This is the only number you ever really need to master.
And here's why this rule is everything. Just look at the math. If you risk 10% of your account on every trade, just a few losses in a row can dig you into a massive 41% hole. To get back to even from there, you need a 70% gain. That is an incredibly steep mountain to climb. But if you risk just 1%, your losses are small, they're manageable, and they're so much easier to recover from. So this is it. This is the golden rule, the single most important habit for long-term survival. Never, ever risk more than 1 to 2% of your total trading capital on any single idea. This one rule, all by itself, separates the survivors from the casualties.
Because here's the secret. The number one goal isn't to get rich on the next trade. The goal is just to stay in the game long enough for your strategy to actually work. You can't score any points if you're not on the field, right? Survivability always comes before profitability. Always.
So, at the end of the day, it all comes down to a choice. There are two paths. The path on the left is the one the 95% take. It's crowded, it's emotional, and it's driven by ego. The path on the right is quieter, it's more disciplined. It's the path of the 5%.
So, I'll leave you with this one question. Forget all the complex strategies and secret indicators for just a minute. What is the one simple rule of discipline you will commit to, starting today, to protect yourself from your own worst instincts? Because your answer to that question, it might just change everything.
Thank you for watching. Subscribe to the channel and click the bell icon to get notified about exciting new content.